The banking regulator APRA has reduced the maximum amount that households can borrow to buy a property in response to a 20.3% jump in property values over the past 12 months. Now, you don't need to be a property expert to know that the current housing market we're seeing is just too hot.
Oh, that's hot. That's hot.
Annual house price growth of 20%, housing credit growth running at an annualized rate of 8%, compared to household income growth of 4%, and a record 22% of loans written in the June quarter at more than 6 times the borrower's income. And while some lucky homeowners have gained $180,000 in value in the last 6 months, yeah, legit. Research undertaken by Canstar shows that a Sydney sider who bought a home for a median house price of 1.12 mil in March with a 20% deposit would have had their property value rise by 16% or by $181,000 by last month. Insane. The reality is that these latest changes are going to make it even harder for first home buyers to get on the property ladder. So in this video, we're going to go through what's happened. We're going to look at how much less you're going to be able to borrow after the changes, who's going to be the worst hit and who won't be impacted, and more importantly, the question we're getting asked all the time, if the Australian property market is going to crash as a result of these changes. But before we start this video, if you find it helpful in any way, do me a little favor and hit that little like button down the bottom. It'd mean a ton. And if you leave a comment below, let me know what you think. It'd do stacks for the YouTube algorithm. Just a little gesture like that can really help a lot. So really appreciate it and thanks for watching. All right, so what's happened? The Australian Prudential Regulation Authority, APRA, sent a letter to the banks this week saying that need to increase their minimum rate buffer on home loan applications from 2.5 to 3%. This all comes into effect from the 1st of November. From that point forward, the bank's gonna have to add that extra buffer to your home loan assessment. So in other words, if you apply for a mortgage with an interest rate of say 2% on November 1st, the bank's gonna have to test to make sure you can make repayments at a 5% interest rate. And if you can't, your application's gonna get declined. If the banks don't use this high test, they'll face massive penalties, so they're gonna do it. In practice, it means all regulated banking institutions, anyone that can take deposits, will have to use this minimum 3% buffer. Interestingly, it doesn't apply at the moment to lenders that don't accept public deposits, kind of like Pepper and Liberty and non-bank lenders, but APRA's warned they might put some more restrictions there if they make risky loans. Home loan applicants, this means the maximum amount that you're going to be able to borrow relative to your income and expenses will be much lower than it is today based on the 2.5% test. The regulator says it's their way to cool off the market and slow things down. But it is worrying for a lot of home buyers out there that are seeing prices going up and up and up, and your income might not be able to keep up with it. Which begs the question, how much less are you going to be able to borrow after these changes? It's so confusing with the media because they talk about 50 basis points, 0.5, 3%. It all means nothing. APRA estimates a typical household's maximum borrowing capacity will drop by about 5%. So under the old rules, a couple of months back, if someone could borrow, say, $500,000, the maximum from the 1st of November will be up to $475,000. So it's a drop of about $25,000. The good news, and from what we see, is that plenty of borrowers don't actually borrow their full borrowing capacity. So the changes aren't going to affect a lot of people. I guess to prove this point, the Commonwealth Bank said that only about 8% of home loan customers borrow the maximum amount they're approved for. And a lot of times the banks cut back on bonuses, they might only use 80% of the income, if you're on maternity leave, they use different things. So it's not going to affect the whole of the market. But with that being said, if you were planning on borrowing in maximum capacity, you may need to reassess some of your home buying plans. Some further analysis by Rate City estimated the average family's maximum borrowing capacity could drop by $35,000 under the new rules. That figure assumes one adult's working full-time, the other's working part-time with 2 dependent children. There are a bunch of changes. Like I said before, it's only going to affect you if you're really borrowing the maximum the bank's going to lend you based on your income, and it's not going to affect you if you're borrowing less than that, or in a lot of cases like what we see, you're actually limited by the amount of deposit you've got. So who's going to be worse hit and who isn't going to be impacted? Well, like I mentioned earlier, APRA has made these changes live from the 1st of November. Different banks are going to have different ways of how they interpret these rules. In the case of Commonwealth Bank, for example, they've said that they're going to honour any existing pre-approvals or approvals that are in train that are in their system before the 1st of November. But any new applications are going to face the new rules. So if you're unsure about your borrowing capacity or if it's going to affect you, check with your mortgage broker or even hit us up. We can check out your borrowing capacity and assessment at huntergalloway.com.au. So the million-dollar question is the property market going to crash as a result of these changes? No. APRA's actually done this in the past, in 2014 and 2017, so these changes aren't anything new. As you can see from the chart, the first round of the policy intervention in December 2014, which involved a 10% speed limit on the amount of investor credit growth didn't actually make an impact until mid-2015. And it was pretty conservative, which didn't actually impact values as much as the amount of growth, with the rate of growth reducing between November and April 2016. The second round of changes came in March 2017, which involved a 30% benchmark on the flow of newly originated interest-only investment loans. Impact of this policy was much more immediate, resulting in the pace of applications for investors completely dropping off. As a consequence, this actually did have an impact on national home values, which declined between late 2017 and early 2018. Credit policy and home loan serviceability assessments were also tightened further during the Banking Royal Commission, and house values again responded pretty negatively. Throughout each of these periods of credit tightening, the impact on housing trends was much more evident in markets that were exposed to the rules. For example, Sydney was a real centre of investor activity, with almost 56% of mortgages in early 2015 being to investors. So as a result, house prices did come off a bit worse in Sydney. But remember, it's only a short period. How does this actually translate to a longer period? We're only talking about periods of 6 or 12 months, and it bounced back pretty quick. It's hard to know exactly how these impacts are going to affect the property market in the short term. But as you can see from the chart here, if you take a 3, 5, 10-year view, it works out pretty good. As we've said before, property is not about trying to time the market, but it's about time in the market. And while APRA is trying to make some of these changes to kind of clean up and tidy up the market, it looks unlikely that it's going to cause any massive shocks in the short term. Which brings me to my next point. Looking at the small segment of the market these changes are going to impact, we actually think it's possible that APRA are going to bring in more changes over the next few months. The APRA chairman said the decision to reduce the maximum borrowing capacity was intended to head off building risk from a growing number of large mortgage applications. His primary concern was actually debt to income, saying more than 1 in 5 new loans approved in June quarter was at more than 6 times the borrower's income, and at an aggregate level, the expected housing growth will run ahead of household income growth in the period ahead. Interestingly, on Wednesday, the Reserve Bank of New Zealand actually increased their interest rates, lifting their benchmark rate from a record low of 0.25 to 0.5%. So it kind of coincided with APRA's announcement. The move came on the back of rising inflation pressures and New Zealand's own housing boom, which has seen price surges of around 30% over the last year, despite moves earlier this year to contain them. Realistically, we get what APRA is doing. They're trying to reduce the vulnerability of individual borrowers and the banks that lend to them. The increased servicing requirements will apply to everyone in the market for a home loan, but realistically, they're going to have the biggest impact on the most leveraged borrowers. And from what we see, most leveraged borrowers tend to be investors. What's been interesting is that investors have been a bit less prominent in the current market than previous cycles. Investors were pretty absent in COVID-19, especially with rental markets being uncertain. And there's talk that investors are starting to return this year to the market, with loans to investors in 2021 lifting back towards record highs of 2016 and 2017, when investors regularly account for about 40% of total lending. Last year, investors fell to just 25% of the mortgage market. But like I said, that number's on the way up. So it's possible later in the year, or even early next year, that APRA could have a look at the investor market and try and slow things down there if growth doesn't slow down the property market. But like I said earlier, it looks unlikely that the property market's going to dive off the cliff. All that's going to happen is growth is going to slow down. It means you're going to have to borrow a little bit less. For most borrowers and most people out there, the biggest limitation is actually deposit. So these changes aren't going to massively impact you. Different banks do have different ways of assessing your income, bonus, overtime, etc. So definitely chat to your mortgage broker to have a look around and see if there's a bank that might be able to get you back to the assessment or the serviceability that you could get before. If you need any help with that, hit us up. We're happy to help out at Hunter Galloway. We're home for home buyers across Australia at huntergalloway.com.au. Until next time, guys, see ya.